Over the last month, the Shanghai Composite Index fell by 30%, leading to global fears that the Chinese stock market might be a bubble waiting to pop. Another concern is that the Chinese economy, the second largest in the world, is seeing a significant slowdown in growth. But joining me to discuss the impact of the Chinese economy and what this could mean for South Africa is Simon Freemantle. He's a senior analyst at Standard Bank. Simon, thanks for your time. Maybe let's take a step back. Before we used to see China's economic growth in the double digits. Now it's expected to be around 7 or even 6%. Why are we seeing a slowdown?
Look, any large economy that grows at that pace is likely to slow over time. Economic growth is a function of improvements in capital and labor and productivity and so on. So we expected there would be a slowing, although this slowing has been faster than was anticipated in forecasts a couple of years ago. The Chinese government now acknowledges that they're growing at, they claim 7%. Some people believe it's already south of that, and going ahead we expect growth to be closer to 6% in the next 2 years. So there's a material slowdown in, as you mentioned, the second largest economy in the world. That means its demand for some of the inputs to drive its industrial production is down, and of course that affects the trade balance quite substantially for those markets exporting huge amounts of raw materials to that market. Another factor, of course, driving China's slowdown has been its internal reorientation of its economic growth, economic model. They've been heavily investment-led, export-led growth over the course of the past 20, 30 years, and the current leader and the premier are trying to reorient that growth to be more inward focused on domestic consumption. In a way, to put it quite basically, they're trying to become a little bit more like the United States, which generates tremendous growth out of its internal engines. The consumer in the US is one of the primary levers of growth in that market. And that comes with pain, and it also takes time. And we're starting to see that the Chinese government has not been willing to just pump huge amounts of investment into the economy to prop up growth this time around. Investment as a share of GDP has probably peaked and is coming down. And as a result of that, there is a very material slowing in the momentum of the Chinese market.
A lot of people, obviously there was a lot of nervousness about a month ago, and probably still is. When we looked at the Shanghai Composite and the fact that it had taken such a hammering, can we say that the Shanghai Composite as an index is a proxy for what is happening in the Chinese economy?
To an extent, yes, but also we need to be cautious of that correlation. There's a lot going on in the broader real economy in China, which is somewhat disconnected from what we're seeing in the fluctuations in the market. The response from the Chinese government was fairly, in a way, surprised the market. They were obviously very eager to prop up some of that slide, and in some senses they overreacted, according to some market commentators. But generally speaking, there's a disconnect between the real economy and what's happening in the Chinese stock market. The real economy is where in Africa we're most concerned. That's where the contagion effect would be most pronounced.
Let's talk about that contagion effect. What does this now mean for Africa and South Africa as a whole?
Yeah, and first, before we enter that, of course, Chinese slowing demand for African commodities is one thing, or commodities in general. The other thing is the massive hit in commodity prices that we've experienced. So it's not just China potentially buying less commodities, also the value of those commodities, which is in part a function of expectations of slower Chinese growth, which is coming through in iron ore prices and copper prices and so on. So Africa, of course, has grown its trade with China fundamentally in the last decade. Last year, the official figures from China were that China-Africa trade was about $222 billion. Now, there's a component of that which is statistically a little difficult to reconcile, but still about $100 billion of African exports to China. And virtually all of that is commodities. More than half of it is crude oil. The rest is composed of base metals. China consumes roughly 45% of the world's base metals. So African exporters of base metals, particularly South Africa, where we export iron ore to China, we export platinum to China, copper to an extent as well. Zambia and the DRC are large copper exporters to China. These are the markets that are going to see a fairly significant slowdown in Chinese demand over time for these inputs. And then, of course, the more material effect, which you've already seen coming through in Q1 this year, is more of the price effect. So the first quarter of this year, Chinese imports of all commodities from Africa were down basically 50% on first quarter 2014, which is a very material deterioration in the trade balance there. And I think we're going to see that coming through in the full year figures for 2015. It's going to fundamentally adjust the volumes of China-Africa trade. And I don't think we're yet fully prepared for that.
And the fact that we are, Africa is so dependent on resources. Is the resources sector the only sector here that's going to be impacted, or the other ripple effects to take into consideration?
From the Chinese perspective, obviously China's become a major player in Africa, and that's come through the political channel, through the investment channel. They've invested tremendous resources, largely into infrastructure development in Africa, and then through trade. We don't anticipate that the investment channel will be affected too materially by China's slowdown. Bear in mind, roughly between $30 and $50 billion China holds in terms of fixed investment stock in Africa, which is very small compared to their global investment profile. Later this year, China will host, well, South Africa, in fact, will host the Forum on China-Africa Cooperation here in the country. During that summit, we expect the Chinese government to make fairly substantial new commitments, lending commitments to Africa. And by virtue of that, they'll lend money, and that money will typically be used for infrastructural upgrades in various African economies. So through the investment channel, we expect a fairly limited effect of China's slowing. But through trade will be the most material. And of course, as I've mentioned, we only really export commodities to China. China exports a tremendous amount of manufactured goods and value-added goods to Africa. For now, the African consumers in most of its key markets is relatively buoyant. Africa's growth rate in Kenya, Tanzania will still be sufficient enough for that export channel to remain quite strong. So it really is just China's imports from Africa that will suffer.
What about other global trade partners and China? That relationship, who is also going to be feeling the pain here? Well,
again, it's your large commodity exporters to China. Peru, iron ore. Brazil, iron ore. Australia, which is one of the largest exporters, base metal exporters to China. Obviously, China is a large importer of oil. The impact on oil seems to be slightly more mild in terms of Chinese demand, but of course the price effect will come through quite acutely. So those countries that export crude oil to China, in the African context, that's primarily Angola and Sudan, we'll see a material price impact there. But yeah, the basic balance of it will be those markets that in the last decade have really benefited tremendously from industrial production growth in China and exporting the commodities that China's needed to fuel that.
We've heard from the IMF. They said China's just starting to understand the stock market, hence these interventionist moves that we have seen from authorities. Are you sharing the same sentiment here? Does this give you a lot more comfort knowing that they are just still learning? Everything might just be okay.
Look, the Chinese authorities have become a lot more open with their ambitions around economic policy, about the redirection of the market. The current leadership of the Chinese Communist Party has been a lot more transparent in that. There's an agenda. They're fulfilling and adopting that. There's a general market comfort with some of the structural reforms that they're taking. And some believe that once these structural reforms take root, China will enter a healthier growth rate, which will be between sort of 5-6%, which for an economy of its size is profound. And we have to go through these teething pains. Then again, there are others who suggest that the over-indebtedness, that we don't know the full extent of some of the financial market challenges that China faces. At the moment, we veer more towards the perspective that the Chinese economy, once it's embedded these structural reforms, will probably be in a better position. But we've got to get there, and I think we're going through that process at the moment.
Simon, thanks so much for coming in, giving us some perspective on China and, of course, our relationship with that particular economy, second largest in the world. Thanks to Simon Freemantle. He's a senior analyst at Standard Bank. Stay with us, because when we come back, we will be looking ahead to Women's Day, which we are celebrating on Sunday, and I'll have two phenomenal women in studio with me. Stay with us.